Hi everybody, welcome back to video number 6 in chapter 16. And when we left off, we were looking at the fair value option note receivable example for the Escobar company, where it received a note receivable from one of its customers for $620,000 on December 31, 2025. On December 31, 2025, the fair value and carrying value of the note receivable is $620,000. Escobar decides to use the fair value option for this receivable. On December 31, 2026, the note receivable has a carrying value of $620,000, but the fair value increased to $810,000 due to a decrease in interest rates. So how should Escobar record this transaction? Because Escobar elected the fair value option, it reports the receivable at fair value with any unrealized holding gains or losses reported as part of net income. The unrealized holding gain is the difference between the fair value and the carrying value. And in this case, that's $190,000, representing this $810,000 less the $620,000. So we're going to debit note receivable for $190,000 and credit the unrealized holding gain dash income for $190,000. Escobar adds the difference between that fair value and cost of the note receivable to arrive at that fair value. Okay, impairment of receivables. The rules for debt investments, debt securities, and debt loans reported at amortized costs follow the same approach that we discussed way back in chapter 6. That is, companies should use the current expected credit loss model to record the impairment of debt investments similar to receivables. Let's take a look. We assume that Chewy Incorporated holds a held-to-maturity bond security with a par value and an amortized cost of $1 million. In evaluating the securities and using the CECL model, Chewy estimates that it will not collect $200,000 related to the debt investment. How should Chewy account for this impairment? As we look at the solution, Chewy records a debit to bad debt expense and a credit to the allowance for doubtful accounts for $200,000. Pretty straightforward there. The allowance that will then be adjusted each period as appropriate. Now, debt investments available for sale impairment values. Now here, the companies that have a debt investments that are classified as available for sale use a different impairment model. Under this model, if the fair value is greater than the amortized cost, no expected credit loss is recognized. The amount of the credit losses that can be realized on available for sale securities is limited to the fair value floor. The fair value floor is determined as follows. We're going to take the amortized cost of the AFS debt security and take away the fair value of the AFS debt security. Okay, and that will give us a fair value floor. Okay. This AFS, of course, stands for available for sale debt security. Now, if we look at a fair value floor example, here we assume that the Peloton Interactive has available for sale security with an amortized cost of $100,000 and a fair value of $90,000 and an expected credit loss on this security of $15,000. How should Peloton account for this loss? First, we'll look at the fair value floor, and that's determined by taking the amortized cost less the fair value cost, or $10,000. Peloton should record a loss of only $10,000, even though it expected this credit loss of $15,000. It could sell the security for $90,000 and have a loss of only $10,000. Okay, little tricky there. Now, impairment analysis, here we're looking at the available for sale investments. So the following illustration provides an impairment analysis based on these impairment guidelines for Alexander Company. So here are our facts. We have our amortized cost, fair value, expected credit loss, the expected credit loss recognized in net income, and the unrealized holding gain or loss equity. So in situation alpha here, we had $1 million amortized cost, fair value $1,100,000. So we had expected loss, however, of $110,000. The expected credit loss recognized in net income is 0. And the unrealized holding gain is $100,000. Okay. Now in situation Bravo, we have the $1 million amortized cost, fair value of $960,000, expected credit loss of $110,000. So the expected credit loss was $40,000. So how much would our unrealized holding gain or loss dash equity be? 0. Then, in situation Charlie, we have the $1 million amortized cost, the fair value of $860,000, expected credit loss of $110,000, and this time our expected credit loss recognized in net income would be that full $110,000. And the unrealized holding gain or loss equity would be $30,000. Okay. All right. In situation alpha, Alexander does not recognize an impairment loss. Let's go back. Here's situation alpha. And Alexander does not recognize an impairment loss because the fair value of $1,100,000 is higher than the amortized cost of $1 million. The entry Alexander makes is to record an unrealized holding gain of $100,000 in other comprehensive income, and that's the $1,100,000 less the $1 million. Alexander does not recognize any impairment because the fair value of its securities is above its amortized cost. Now in situ, and there's our journal entry, fair value adjustment, $100,000, credit to unrealized holding gain or loss dash equity, $100,000. Now, under situation Bravo, I go back to situation Bravo here. Here's our amortized cost of $1 million, fair value of $960,000, expected credit loss of $110,000, and so the expected credit loss recognized in net income is going to be $40,000. And if I look at that, Alexander is going to recognize an impairment loss of $40,000. That's the $1 million less the $960,000. Even though the expected credit loss is $110,000. In other words, Alexander's impairment loss is limited to the amount that the fair value is less than the amortized cost. So Alexander now is going to make the following journal entry where it debits bad debt expense and credits the allowance for doubtful accounts for $40,000. Now, in situation Charlie, we'll go back and look at that real quickly. We got $1 million amortized cost, fair value $860,000 expected credit loss. And now Alexander recognizes an impairment loss of $110,000 and an unrealized holding loss through other comprehensive income of $30,000. In other words, Alexander separates the total loss of $140,000 into two components. One is going to be the credit loss, or the amount representing the decrease in cash flows expected to be collected, which was the $110,000. And number two, the non-credit related factors such as changes in interest rate, market volatility, and liquidity concerns of $30,000. Okay, so it's going to make the following journal entry pretty straightforward once we've got all the numbers clearly in mind. We have a debit to bad debt expense for $110,000. We have a credit to unrealized holding gain or loss dash equity of $30,000. I should say that's a debit. And then a credit to allowance for doubtful accounts for $110,000. And then a fair value adjustment of $30,000 credit. All right. The impairment model summary then, I think the asset measurement basis and the impairment model here. So loans, receivables, and debt securities measured at amortized costs. The impairment model is the expected losses recognized in net income. For debt securities measured at fair value with gains or losses recorded in other comprehensive income available for sale, the impairment model states that no expected credit losses are going to be recognized if fair value is greater than or equal to amortized cost. If the fair value is less than amortized cost, the expected credit loss is recognized in net income. Credit losses are limited to the difference between fair value and amortized cost. And finally, our debt or trading and equity securities measured at fair value with gains and losses recorded in net income. So the impairment model measured as the difference between the lower of amortized cost or fair value, debt and securities, or lower of cost or fair value for equity securities. Quite a mouthful there. Okay, so how do we present comprehensive income? Companies may display the components of other comprehensive income in one of two ways. One, in combined statement of income and comprehensive income, or two, in separate statement of comprehensive income that begins with net income. Okay, let's take a look at the single period example. This looks like a good place for us to stop this video. And when we return, we'll take a look at this single period example. Until that time, bye for now.